Good morning, everybody. This is a quick tutorial, at least I'm hoping it's going to be quick, on bad debts. Another video walkthrough on how to handle 3 different methods of calculating bad debts. We first talked about it in the first unit very briefly, but there are 3 ways to calculate it. That's what we're going to go through right now. Okay. Look, you'll have to excuse me. I'm fighting a cold. If I have to take a break and hack up a lung or something, just put up with me for about 5 seconds. I'll be right back as ready as rain. Okay, so look, there are 3 methods that we worry about. The first one we're going to talk about when we're calculating out a bad debt is the direct write-off method. This is actually pretty straightforward. In this case, the A company has realized that the B company, Inc., pardon me, will not pay them the $1,000 account receivable that they are owed. Remember what bad debts are. Bad debts are accounts receivables that a company will not be able to get back to them. Okay, somebody, for some reason, maybe the company's gone out of business, maybe they're delinquent in their payments, what have you, they're not going to get paid. In the direct write-off method, that's probably going to be our simplest one. What we're going to do is we're going to debit bad debt expense, and then we're just going to credit accounts receivable. All right, so it's just a very straightforward, simple transaction. We debit the bad debt expense for the $1,000 that we're not going to get back, and we credit accounts receivable, and you write to write off amount uncollectible as your description. Okay, pretty straightforward, pretty simple. Now that I've shown it to you, you have to forget it because we don't use the direct write-off method. The reason is because it violates GAAP. Okay, we cannot use this because what's happening is you're matching up the expense in the period in which the accounts receivable is not going to be collected, and that violates the matching principle. Remember, the matching principle says that we have to match up all expenses to the revenues in the same period in which they're earned. We're not doing that here, okay, because we're waiting until the actual account is not receivable. You have to account for it in the period in which it's been earned. So that's why we can't use the direct write-off method. I'm still going to expect you to understand it. You're still going to have to know it. Just you can never use it in practice. Okay. So that being said, let's move on to number 2. One we can use. Okay, the income statement method. Okay. Now it's called the income statement method because, and you'll look at this chart here. I'm just going to quickly circle this. We base the amount that we're not going to be able to collect upon the credit sales amount or the revenue amount. Right, so we're looking at an income statement balance, an income statement line item, the sales amount. That's where we're going to determine the amount where they're totally written off. So in the year 2010, 10,000 credit sales were made, $500 worth of those were written off for 5%. In 2011, that became 6%. In 2012, that became 2%. So we're in 2013 right now. We need to calculate out the journal entry for the allowance for doubtful accounts. So we know that this year we have credit sales of 18,000. That's a good start. Well, we have to figure out how much is going to be written off. To do that, we look back at the past 3 years' trends. We're going to take the 5%, the 6%, and the 2%, and divide that by 3. Since there's 3 years worth of items. And that will give us a grand total of 4.3%. So we're just kind of estimating that this year of credit sales, we're not going to be able to collect 4.3% of those sales. So you now take this number, uncollectible. All right, to calculate the uncollectible, we take the $18,000 that we have in sales this year, 2013, and you multiply that by 4.3%, the number we just calculated here. And that gives us a grand total of $774. Okay, so 2 quick calculations, 1 calculation, 2 calculations, and you're ready to make your journal entry. All right. So what we're going to do is we're going to debit bad debt expense, and we're going to credit that account called the allowance for doubtful accounts. Okay, now you remember that before, that this account here is actually going to show up on the income balance sheet, pardon me, right underneath accounts receivable. All right, so that's going back to Unit 1. Hopefully that's a bit of a refresher, but remember that the allowance for doubtful accounts is a contra account on the balance sheet. And what we'll do is we'll just debit bad debt expense for 774, credit the allowance for doubtful accounts for 774, sorry it's getting a little tight, and then just write out to write off uncollectible accounts. Okay, and that's all you do for the income statement method. All right, that's it. That's the only step you have to make. So we'll move on now to the third and final one, the balance sheet method. We call it the balance sheet method because we actually look at accounts receivable accounts specifically. So Wright, Davis, Telmoon, all three of those are accounts of specific accounts receivables that the company is owed. So Wright owes them in total $1,650. 1,000 of which was owed within the last 30 days, 600 of which was owed within the last 2 months, 50 of which was owed more than 3 months ago, pardon me, between 2 and 3 months, and they don't owe anything over the last 3 months plus. That gives us a grand total of 1,650, and it's the same thing for Davis. All right, they have 200 over the last month, 300 the previous month, nothing the previous 2 months, and then anything 3 months or more. In fact, they owe us $1,000, which is actually quite a bit. So what you'll do is I'll give you this chart. You won't normally have to calculate it, except for one exception. You total up and you get 6,200 in this column. You get the 2,650 here, the 250 here, and the $1,000 there. This is always going to be given to you, the estimated percentage uncollectible. So over the first 30 days, if they haven't been paid between 1 and 30 days, they expect that around 2% of those aren't going to be collectible. And that works out to about $124. All right, the 31 to 60 days, $2,650, which is 5%, works out to $132.50. This works out to $1,750. And then this number here works out to 100, okay, of what we're owed over those days. And you'll notice that the percentages actually increase the older the accounts receivable is, which kind of makes sense because the longer it takes for someone to pay you back, the less likely it is that they're going to actually pay you back. I think we've probably all been down that road, either one way or another. Okay, now we get a grand total of these 4 figures here, and that gives us $374. Okay, now something to keep in mind, and this definitely harks back to Unit 1. All right, they already have a balance of $250 in the allowance for doubtful account. All right, so when we make our journal entry, we don't actually debit bad debt expense and allowance for doubtful accounts for 374. We're going to take the difference. So quickly, what I'm going to do is I'm going to take 374, which is what we calculated right here, and I'm going to subtract the 250 from up here, and that gives us $124. So on December 31st, what the journal entry is to update the allowance for doubtful accounts will be December 31. Bad debt expense is your debit. Your credit is going to be, again, allowance for doubtful accounts. And we are going to debit the expense, pardon me, for $124. I did it again. I think I learned $124. And you'd credit the allowance for doubtful accounts. And this is to update the allowance balance. I'm going to write that very short form because I'm running out of space. Okay, that's what happens on December 31st. Now, I'm going to run through, and I'm sure you're asking, because I know you're so inquisitive, what happens when somebody actually doesn't pay us? Because this is just an estimate, okay, this figure here. It's important to understand that they're just guessing that nobody's going to be paying them the $124 over the course of the next year or so on top of what's already sitting in that allowance for doubtful accounts. But what happens when somebody actually calls them up and says, look, I'm out of business, I can't pay you, I'm sorry, you're not going to get your $100 receivable, which is what happens here on February the 2nd with Telmoon Distributors. Okay, it's totally uncollectible, they're not going to get it. So our journal entry is actually pretty straightforward. On February 2nd, you're going to debit allowance for doubtful accounts. Okay, which remember is that contra asset account. And we're going to credit accounts receivable because that $100 here is sitting in that accounts receivable balance on the balance sheet. And we're just going to make it nice and simple for the $100 that is not going to be payable or collectible, right? And this, the simple description is to write off tell immune account. Okay, plain and simple. Now, just in case, and we always play the devil's advocate in accounting, it can happen. Let's say, for example, and in part C, we're going to explore this. Telmoon calls you up on March the 15th and says, well, wait a second, you know what's happened? I talked to my lawyers, we worked things out, I found some work money from my creditors. I can actually pay you that $100 now that you had previously written off. Okay, what is the journal entry to show this receipt of payment? Well, on March the 15th, all I want you to do is debit accounts receivable and then credit allowance for doubtful accounts. Okay, so you're reversing this entry here. Okay, you're simply reversing the entry we just made. And then on the 15th, you're going to debit bank and credit accounts receivable. Okay, to record, record receipt of payment. Because what's happened here on this first transaction is that we are increasing the accounts receivable that we're owed here and reducing the allowance for doubtful accounts that doesn't exist anymore. Okay, it's not something we have to worry about any further. Okay, and then the bank here is what we actually got paid. Okay, we got paid $100 by Telmoon, and that reduces the accounts receivable. It might look a little strange because, yes, you're right, we're sort of canceling out the accounts receivable amounts. The reason we have to write it out in two separate journal entries is to make sure that it's actually fully recorded and clear to anybody reading the income statement, the journal entries, any auditor that comes in, that they're clear and fully understand what's happening here. Okay, that's it, guys. Hopefully you enjoyed it. I enjoyed bringing it to you as usual. And if you got any questions, let me know. Thanks, guys. Have a good day.